Welcome to Bad Takes. I'm Laura McGann, the executive editor of Grid, and I'm here with my co-host, Grid contributing editor Matthew Iglesias. Hey, Matt, how's it going?
It's going well. It's going well. Have you seen any takes lately that you thought were bad?
Why, in fact, yes, I have.
Wow.
I know. Every week, we think we're going to run out, and we never do. So this week, we're going to talk Silicon Valley Bank. And for those of you just catching up on this, I suppose everybody has heard Silicon Valley Bank collapsed this weekend. The FDIC stepped in, and now depositors are getting their money back. It's everybody, even if your account wasn't insured. So that's where we are. And explaining what happened here, I want to flag a Wall Street Journal column by Andy Kessler. And generally speaking, when I read an Andy Kessler column, he does analysis. He's an opinion writer for the Journal. And I usually, take something from it. I find his work valuable. And in this case, he has a piece this week called "Who Killed Silicon Valley Bank?" And the deck of it is apparently no one at the firm perceived any risk from the Fed raising interest rates. So his piece goes on, and he starts explaining this concept, and I'm nodding along as I read of, okay, so there was this problem, but interest rates went up and they were banking, their whole model was based on interest rates staying low. And then kind of towards the end of the article, he comes at us with this just really great bad take. And I'm going to just read that part right now. Was there regulatory failure? Perhaps. SVB was regulated like a bank, but looked more like a money market fund. Then there's this. In its proxy statement, SVB notes that besides 91% of their board being independent and 45% women, they also have one Black, one LGBTQ, and 2 veterans. I'm not saying 12 white men would have avoided this mess, but the company may have been distracted by diversity demands.
Well, that's a doozy. It's hardly unique. Tucker Carlson on Monday night said, quote, "The Obama administration imposed diversity, equity, and inclusion standards on the entire financial sector, and that's one of the main reasons our big banks are now increasingly incompetent." If you remember when Barack Obama became president, it was late January 2009. I don't know when these alleged DEI standards came into the banking sector, but it would have been sometime after 2009. We had a rather severe banking and financial crisis in 2007, 2008, back before any of this. So not only is it, I think implausible on its face to say that having one Black board member out of 12, which is just like a regular population level representation, they were maybe a little overweight on military veterans, is responsible.
Yeah, maybe that was the issue.
And then I saw a good take from Kevin McCarthy, who apparently had a conference call with members, and he was trying to, Kevin McCarthy, whatever else you may say about him, represents the Central Valley in California and doesn't like to see California banks collapse. And he was apparently trying to talk his caucus down off this hill and tell them to talk about interest rate dynamics, not wokeness. Kevin Hearn, who's the head of the Republican Study Committee, said, quote, "Members and staff don't know what's going on and should stop tweeting/going on TV if they don't understand," which is always good life advice, but, hasn't stopped anyone.
Yeah, in this specific case. And just to note that Kevin Hearn he runs the Republican Study Committee, which is sort of the precursor to the rise of the Tea Party and the rise of the kind of far right that we see now. This is not some moderate Republican or something saying this.
But this is one of these things, though, that happens in politics, right? Where it's like, we were talking just last week about everything Republicans don't like is wokeness, and everything that's bad is wokeness. And just for newer members, right? Like for this has just like been the bandwagon that the conservative movement's been on for the past 5 years or so. So then you have some older hands like McCarthy and Hearn who are just trying to be like, hey guys, like there's also a part of our movement where we talk about free markets or where we worry about interest rates or whatever else. But there's just this kind of like autopilot. Like what we're doing is we complain about DEI. And so then whatever happens in the news that like must be that fault, to the point where the guy is literally saying like, this bank failed because there were women on the board. And then he's like, I'm not saying the bank failed because there are women on the board. But like, that's what he's saying.
Yeah. I mean, he says, I'm not saying 12 white men would have avoided this mess, but the company may have been distracted by diversity demands. I mean, he was trying to thread that needle and say, I'm not saying it's the presence of the one Black person and the women and the one LGBTQ person. I'm not saying it's that. I'm saying, white men were very distracted, and unable to pay attention to interest rates because they were busy trying to find women and a Black person to put on the board. And maybe if they hadn't been so focused on those recruitment efforts, then they would have noticed that the Fed was raising interest rates, which, I noticed. I think most people noticed that rates have been going up.
So let's talk about Silicon Valley Bank and our understanding of what actually occurred here.
Yeah.
So banks have deposits, which I think everybody knows. What normal people don't think about is that in legal terms, a deposit is a loan. When you deposit your money at the bank, you have loaned your money to the bank. Now, it's a special kind of loan where, unlike a normal loan, the terms of the agreement are anytime you go ask for your money back, the bank has to give it to you.
Right.
But it's still a loan, which is what leads to like that famous "It's a Wonderful Life" type stuff, right?
Well, and to think about, that's why you get your paltry interest on your deposit.
But I mean, I would say even more than your paltry interest, right? Like the bank provides you with useful services. Right? Like they hold your money, they keep it safe. If you need to deposit checks, if you need to get ATM, right? They provide all these payment services to you, and they don't charge you for those if you maintain a minimum account balance. If you have so and so much in your account, you get exempt from all their fees and stuff because they want you to loan the money. And as it turns out, a majority of the money at Silicon Valley Bank wasn't earning interest at all. So if you have less than $250,000 in your account, it's fully guaranteed by the FDIC. But if you have more than that, because either you're very rich or more likely because you're a business that, a business needs a lot of money around on any given day because, when checks come in and when checks go out doesn't perfectly line up.
Well, yeah, your payroll each month could very well be more than $250,000, and you need your money in there to cover your payroll, which is what came up with Silicon Valley Bank, which was, how are we going to make payroll next week if this bank is closed?
So, there are different reasons you could have uninsured deposits in a given bank. But it seems like what Silicon Valley Bank did was they got very, very good at providing banking services to tech startups. And tech startups often have this unusual situation where you might have no revenue, right? But venture capitalists have put a lot of money into your company and they think it's really promising. And the whole Silicon Valley Bank deal was they did business with the main venture capital firms. They had good personal relationships with the leading venture capitalists. So when the VCs would say, hey guys, like this company's legit, we're investing in them, you should bank with them, even though they have no revenue and no tangible assets, Silicon Valley Bank would do that. So they became the preferred banker to the majority of startups in the Bay Area. So why would you do that, right? Why would you put yourself out like that as a bank? Well, the reason is that they then became the preferred place to put your deposits. So all these companies, which were often quite cash rich, and their founders and everybody else, they were doing their banking with Silicon Valley Bank, even though Silicon Valley Bank's deposit terms were not very generous. Matt Klein has a great post. He looks at it. A majority of these deposits were not only uninsured, they were paying no interest, right? So Silicon Valley Bank was getting giant uninsured, zero interest loans from tech startups, venture capitalists, and startup executives because it was doing all this other stuff on the banking side for them that they liked. But that puts you in an inherently dangerous situation because you have borrowed money from someone who is entitled to ask for his money back at a moment's notice, and you're not paying him any interest, right? The only reason he's leaving his money in that account with you is a kind of, I don't want to say laziness, but it's just like it's annoying on any given day to close your bank account and move all the money out. But it meant they were left in this inherently very vulnerable position to bank runs. And then what they did was they took, I don't want to say all that money, but like the bulk of that money, they went and they bought long-term treasury bonds. And those are considered very safe. But when people say they're safe, what they mean is that the government isn't going to default. Like the government's going to pay you the interest it said it would pay you. But then when interest rates go up, those old bonds become less valuable. So if you have to sell them in a hurry because your clients are taking their money out of their bank accounts, you're going to find that you take this big loss because your bond, even though the bond is still good, right? The bond isn't defaulted. But if you have to take it to the market, people say, we don't want your shitty old bond with this low interest rate from 3 years ago. We want today's fresh new bonds.
I'd buy a new bond that has a high interest rate. So you're going to have to sell at a loss, which is what Silicon Valley Bank had to do early last week. And they had this $20 billion gap, and they went around looking for some cash to fill the hole. I did think I saw one note of this today that maybe Silicon Valley Bank shouldn't have sent out a press release saying, hey, we're short on cash. Anybody want to give us some cash? Because that probably didn't help. But nonetheless, people knew. I mean, there's a whole Slack room of people who had their money in this bank going, hey, we should probably take our money out immediately. Things are not looking good. And it's pretty classic, right? Like pretty classic. You just started to talk earlier about the It's a Wonderful Life situation where there's this panic and then everyone wants their money. And of course, it's not like your bank is Scrooge McDuck with a big vat of money sitting there ready to go.
Right. And what's interesting is, I mean, it's also not like an empty vault, right? It's like what they had in the Scrooge McDuck vat was all these bonds.
So you could make them liquid quickly by selling them, but it's not that what I'm saying is Scrooge McDuck's pile of money is not dependent on other factors. It's just sitting in there. It doesn't matter what else is happening in the broader economy.
Then I think what normally happens when a bank fails is the FDIC comes in on Friday, they shut it down, and then over the weekend, they find somebody else to buy the bank, right? And the reason another bank wants to buy a failed bank, there's sort of two reasons. One is that you can buy the failed bank for $0, which is usually an attractive price to buy things. Because all the FDIC wants is for you to say to the bank's depositors, hey, don't worry, if you want your money back, we'll give you your money. But part of the magic of banking is that if everybody feels they could get their money back if they wanted it, then in practice, they don't show up and demand the money. Right? So you come in, you get a bunch of client relationships, you get a bunch of bank branches, you get a bunch of assets, and you don't need to pay any money for it. Right? Because all you're doing is you're promising to give the depositors their money back if they want it. But because your promise is credible, they don't actually want it. So you don't do anything. And this happened to me. When I first moved to DC 20 years ago now, more than 20 years ago, I think, I needed a local bank because I had been banking with a bank that only operates in New England. And so I needed a DC bank, and I didn't know what to do. But Riggs Bank had a branch right by my apartment. It was this nice old building, classic bank. Riggs is a very old DC banking house. They helped finance the Civil War, very distinguished. So I put my money in with them. And about a year and a half later, I read a story that Riggs Bank was under indictment by the federal government because they had been doing some investigations and Riggs had been laundering a lot of money, I think for drug cartels and also for terrorists. It was like really bad stuff. So they were going to be hit with massive financial penalties by the government. The problem with levying a huge fine against a bank for doing crimes is that once the bank pays the fine, there's no money left to cover the depositors. So the bank collapsed. I didn't go rush to pull my money out, though, because the bank was closed by the FDIC. And then they announced Monday morning all the Riggs branches are going to reopen as branches of PNC Bank, which I'd never heard of, but it's based in Pittsburgh. And they wanted to move into the DC area. And so there was no problem. PNC promised to cover my deposits, but they never had to. They just sort of did it. And PNC was a well managed bank. And then in the financial crisis of 2007, 2008, when a lot of banks went bust, PNC bought up several more. They had a aggressive CEO who wanted to expand. And, it's all good. Banks fail, they get taken over by bigger banks. The federal government doesn't spend any money. Depositors don't lose anything. Everybody's happy. We all love the FDIC. We all talk about It's a Wonderful Life, and it all goes well. The problem arises when if the bank that fails is pretty big, then the list of banks that might buy it gets really short. And then it's not obvious that you're going to have a buyer. And that was the deal with Silicon Valley Bank.
Right. Is that you needed a lot of money to be able to accommodate the size of the bank. I was also under the impression that it wouldn't have been a normal, like the level of risk of taking it over appeared higher potentially. I don't know the exact calculation that banks were making on that front, but certainly there are big banks that could have absorbed it.
So I spoke to somebody who was involved in the effort to find a purchaser for Silicon Valley Bank. And they said there were two problems that arose. I mean, three, right? The first problem is just that the list of potential buyers was short, right? It wasn't like there's 100 people, right? So if 100 people want to bid on an asset, you're bound to get a good offer. But here you're not looking at that, right? The FDIC wanted a bank that was big enough to absorb the liabilities and also that had the management capacity to deal with all of these sort of complicated relationships with venture-backed startups. So there just weren't that many banks that they could go. Some of the banks were concerned about legal risk. If you Google, you will find that in 2013, JP Morgan paid a historic fine to the federal government for fraudulent mortgage origination back during, the housing bubble days. What a lot of those stories didn't fully clarify is that JP Morgan did not actually do the fraudulent mortgages that they were paying the fines for. That mortgage fraud was done by a different bank called Washington Mutual. Washington Mutual failed in 2008, and JP Morgan bought them. The federal government then felt that by having bought Washington Mutual, JP Morgan inherited their past financial crimes, that's not a crazy theory. I mean, they had their reasons for advancing that legal theory, but it has now made banks more reluctant to quickly buy other failed banks because you have 48 hours, right? That's not enough time to fully interrogate. Like, we just gave you the public's understanding of how Silicon Valley Bank failed, because I'm not going to accuse them of being guilty of serious financial crimes. At the same time, the odds that a failed bank was doing some shady stuff, it's not zero.
Yeah, and we knew some little stuff was coming out about part of you were raising why would you put your money in this place? It's not giving you interest, et cetera. And there's already starting, some reporting trickling out that these venture capitalists were getting pretty good mortgages. They were getting equity lines of credit, and then written into agreements with startups was you will use SVB as your bank as part of the agreement. So then it's like, is it legal? Is it not? Nobody was accusing them of illegal behavior, but it's like, this bank was clearly, as you were saying, there were some complex relationships being set up here to support
it. Suppose it turns out in the future that executives were being given sweetheart loans, right, at submarket rates in exchange for taking corporate funds and putting them into uninsured zero interest rate accounts, right? Now, if that was happening with like a wink and a nod and like a subtle understanding, that's probably fine. But if there's paper on it, that could be illegal. And again, I'm not saying that happened, and I don't think any of the banks considering a purchase are saying it happened. What they are saying is that they didn't have time to investigate whether or not that happened, and so they wanted the federal government, they wanted the government to promise them no legal liability. And the FDIC either couldn't or wouldn't make that promise. So that was one issue. The other issue that was giving banks pause is that on Friday, I think people felt, okay, Silicon Valley Bank, whatever its problems on the investment side, has a valuable franchise, right? It's every venture capitalist and every tech startup's favorite bank. So if you are a kind of boring regional retail bank, if you're PNC or your Key Bank or your US Bank, right, one of these banks that has the capital, you could buy this and you could become like a cool bank, that's like dealing with all these venture capitalists, all these startup executives. You've got big new money-making opportunities, so you're excited to do that. I think over the course of Saturday, executives became concerned that Silicon Valley Bank would lose that business no matter who bought it. Right, that the VC crowd had just gotten disillusioned with this operation.
You're not going to necessarily, you might acquire all of these depositors, but that doesn't mean they're going to stay with you.
Right, that's the whole issue. These were uninsured, non-interest bearing deposits. Where like the question is like, why would you park so much money in an uninsured, non-interest bearing deposit? Well, if you put it in there in the first place because of your personal relationships, well, it's like, what are you doing, right? Nobody can promise to the acquiring bank that like all the VCs are going to keep, or you even could promise, but it's like, it's inherently non-credible. And so those two factors, right? People didn't want to assume legal risk, uncertain legal risk for this kind of hazy upside, because on some like fundamental level, I don't want to say the business relationship didn't make sense, but it's not fully transparent from the outside.
PNC's risk level of saying, yeah, we're going to buy up Matt's deposit from Riggs Bank. Chances are you're like, okay, great. Everything's the same. As far as I'm concerned, it's fine. I wasn't unhappy with my interest rate and my ATMs and whatever. And then now it's just going to say PNC on my statement, and that's fine. But this situation, it's not the same, that these depositors are not just your normal depositors who don't really care. They just need a bank. And if it rolls over, that's fine. The risk is much higher of acquiring this bank because you might not get to keep those depositors. It's not the same risk calculation. Setting aside any legal, anything, it's a different calculation. It's not the same as some other bank.
So then what you're supposed to do in that situation, if there's no buyer, is you sell off the assets, right? You sell the bonds. The bonds had lost about 15% of their value. But 85 cents on the dollar is not nothing. And then you would give back the depositors their insured deposits, right? So $250,000 plus 85 to 90% of whatever was above that. And I don't know. I don't know if they made the right call or not.
I don't think the issue here is just legally, but they had to come up with a legal way to do it. to solve the problem.
The FDIC's legal authority to bail out uninsured depositors is that if 2/3 of the FDIC board, because this is like a bipartisan commission where it's like it's 4 Democrats and 3 Republicans. So basically you have to get some members of the opposition party to agree, and you need 2/3 of the Fed board, which at this point I think is about half and half Democrats and Republicans, to agree that there's a systemic risk to the banking system. So the official finding that they made was if they made the uninsured depositors take a haircut, that would cause uninsured depositors, basically small business and medium-sized business owners at other medium-sized banks around the country to pull their money out, and you would have more bank failures. So by bailing out this one bank, not bailing out the bank, people get very upset. By bailing out the bank's depositors, you avoid failures at other banks and sort of, help everybody out and ultimately reduce FDIC expenditures. So that's what they went with ultimately.
And I think it's important to note that the way they did that is they've got a bucket of money that's paid for by fee. The banks put in money into an account, basically paying fees, right? So that's where the money's coming from. They didn't have to go to Congress and get a bunch of money to do this. That there was money in an account that could bridge this problem using bank paid fees.
And a lot of the rhetoric I heard around this from tech people, from VC people, characterized deposit insurance as like a service that the government provides to certain banks and that was being denied, to Silicon Valley Bank. That's a misunderstanding. If you want to know why there's a cap on insured deposits, it's because the banking industry didn't want the deposits to be fully insured. Because if you fully insured the deposits, then the deposit insurance fees that banks pay would go up, right? The scenario banks wanted was one in which the deposits aren't insured, so they don't have to pay insurance premiums on them. But then if a bank does fail, the government sweeps in and insures the deposits anyway, right? So
that's a sweet spot.
Yes. But so what has happened here is just exactly what the banking industry wanted to happen. And I think that that's just important to understand, right? This is the banking industry's dream, is to come around and say, we're going to get these deposits and everybody's going to be able to get their money back. And then the regulators say, well, wait, is that true? Those deposits aren't insured. Maybe we should insure them all. And the industry says, no, there's no need for insurance. It's fine. And then a bank fails. And then as soon as a bank fails, they all turn around and they say, oh my God, you got to insure the deposits, right? So, I think that's all sort of important context to understand, because again, this sort of blaming of wokeness or diversity and inclusion, it really just misses the boat on what's a regulatory issue that has had multiple breakdowns. And that starts with the fact that about 5 years ago, I wrote several very little read bad traffic articles about a bank regulation bill that went through Congress. And the whole premise of that bill was that the Dodd-Frank rules that had come in were too broad and that they were classifying all kinds of regional banks like Silicon Valley Bank, as the equivalent to Chase and Wells Fargo and Bank of America that were much, much larger. And the CEOs of those banks said, look at us. We're just these small-time regional banks.
Mom and pop banks.
providing services to local companies. And the specific claim they made, right, is that if one of our banks fails, it can be resolved through the normal FDIC process. There is no systemic significance. And Congress bought it. I mean, it was all Republicans voted for it, and about, I think, a quarter of Democrats.
It wasn't just one senator from West Virginia who flipped it. It was a sizable number.
Trump signed it. And then they fought it out in the regulatory agency.
Should we take a break right now before we
let's do it.
Yeah, before we pivot. Okay, we are back. So there's a lot to be said about why specifically Silicon Valley Bank failed. And I want to revisit the take we talked about at the top of the shifting of blame from kind of what we've been talking about, which is the institutions of banking and mid-sized banks really wanted the setup that we saw here, where they want to not pay fees, not pay insurance, not pay premiums, and then get all the benefits of being insured. But you can't, that's not a very good place to be. You don't want to be the bank lobbyist out there. You don't want to be somebody out there having to say that. And, we're seeing this shift now to, the problem is wokeness. And that's what's going on here. I mean, it's just very hard for me to want to take that very seriously and really unpack that. I think we could on its face say it was not the individual members of this SVB board that caused the problem. It wasn't that the executives at the bank were distracted by this. In fact, this was exactly what they had pushed for, what they wanted. So you should really probably say, in fact, they were not distracted. They got exactly what they wanted, and there are consequences for that. Last week we had talked about, so they were not distracted. I think we can conclude that looking to hire 2 veterans was not the issue here. But to your point that we talked about at the beginning, and something we had talked about last week, is I have kind of come around to something that I disagreed with you on last week, which was that woke is ill-defined, and so therefore the right is latching onto it and calling anything, using it as a sort of catch-all phrase for any sort of dispute the right might have with the left of this is woke. The problem is this is wokeness. And I last week was thinking the point of some of these kind of woke movements on the left, the reason they don't want to define themselves or clearly call themselves a separate group is that if your goal is to be mainstream, you don't want to define yourself in some sort of alternate wing. And I'm starting to see your point that maybe you don't want to ill-define who you are and what you are as a political movement. And I'm increasingly won over by that as I'm watching this unfold.
Well, because here is what is true about Silicon Valley Bank and wokeness, right? Is that Silicon Valley Bank, back when it was a going enterprise, had this diversity, equity, and inclusion program, right? And you can still see it on their thing. Diversity, equity, and inclusion at Silicon Valley Bank. We believe inclusion ignites innovation. We embrace diverse perspectives and foster a culture of belonging. And so they have all this stuff, building equitable processes, policies, and programs. Workforce diversity matters. And they have these little charts, showing like their staff is 22% Asian and 9% Latinx. Now that the right is on the rampage about this, what people on the left are saying is like, hey guys, like this is BS, right? Like this is just a bank trying to make money and it's putting out some diversity stuff as window dressing, which I think is 100% true. I don't think that people at Silicon Valley Bank care at all about diversity, about equity, about inclusion, about racism. For that matter, I don't think they care at all about innovation. Right? It's just like part of their brand is Silicon Valley Bank is saying they care about innovation. Like it's a fucking bank. They care about making money. But I think it is a problem for people who care about social justice, for people who care about racism, for people who care about inclusion, that they themselves do allow their own brand to be so easily co-opted by everybody. You can't just say after the bank fails, you know what, like pointless DEI initiatives is not what racial justice is about. You have to define your agenda somewhat, because like it is true if you look at it that they have achieved, a senior leadership that is only 62% white. And because they love diversity, but it's like, who cares?
Just because I don't think that DEI caused the downfall of SVB doesn't mean I think that DEI is useless and was doing nothing inside of this institution. The inverse isn't necessarily true. One thing I'm curious about, and I haven't gotten the answer to, is that if you're a depositor who is being kind of, bailed out, I guess is a negative word, but anyway, bailed out with your uninsured deposit, I would like to know more about the companies that were invested in by these VCs, these different startups, who was leading them. Was this real? Because it is a problem in the world of investment that women get just a tiny, tiny fraction of the pie. And it is a problem. We also know that we do know measurably that women are less inclined to take big risks. And when you have women, part of the California's argument of diversity on boards, which I don't know exactly if this is another question I've had, is 40% of the board at SVB was women, and I think part of that would probably because California mandated this, that boards had to move in this direction, and companies had warning that you have to have more women on your boards. And part of the argument was there's some research that shows when you have women on boards that the company does better, that there are reasons why beyond just sort of you can hate women. You can even hate women. Like, we don't care. You could be a sexist, whatever, but it is in your financial interest to have some women on your board. And, SVB, if you look at it, aside from the fact that they didn't move money out of bonds when Jerome Powell was clearly saying that interest rates were going to go up, and they waited too long probably to sell some assets. I don't know that DEI didn't actually make it a better bank. Like, did they bring in more companies because of it? I just think that what you're saying here of, okay, if the argument is the problem is this bank was woke and your argument is, oh, well, that was all fake anyway, I don't necessarily agree with that. I do think that there are, like, I'm thinking about this website. I haven't looked at the page. And sometimes you do get these like clearly bogus window dressing type websites. But at the end of the day, if you really are hiring a diverse staff and you really are investing in startups that are run by diverse people, I actually think that is substantively good.
Right. But I don't think they're doing that. Right.
Well, and I don't even care where somebody's heart is. That's the other thing. Like, I don't care. Like, you can feel however you want.
But this is what I mean. There's no, we got to see all of venture capitalism Twitter talking about the deposits with Silicon Valley Bank. And it's a bunch of wealthy white men who enjoy high risk investments who were quite successful in that field.
But the venture capitalists aren't the only depositors. The point I'm making is that you created a bank where venture capitalists could then find a place for, like, if I'm a small startup run by a woman, I'm getting my money together.
I think that people in the DEI world try to have it both ways, where when corporations and institutions make shallow commitments to diversity, they're like, oh, that's nice. And then when it turns out that these are bloodthirsty capitalists who just want to make money, they're like, oh, no, that's not what we meant. Right. And that's just because of what we were talking about last week, which is it's not a well-defined proposition. Like, what do you need to sign up for to actually care? But I want to pivot away from this because the whole thing is a red herring. What I feel like people have not talked about enough right now is that even in Silicon Valley Bank's deregulated state, banks are still regulated. They went to a lighter touch mode of regulation, but not no regulation. The San Francisco Fed is supposed to be monitoring the banks that it's the primary regulator for. and saying something, right? Like one of the things that was going on with Silicon Valley Bank is that the size of their deposit base was just growing incredibly rapidly. Basically, like their clients kept getting richer, because there was a big boom for tech. So they went from being like a small, medium sized bank to being a large, medium sized bank really, really, really fast. And, you know, regulators are allowed to step in at a time like that and say, whoa, like, what are you doing with all this money? It's an unusual problem to have for a bank. Like normally, if you're a bank, what you're trying to do is you are spotting investment opportunities that you think are good. And then you're trying to raise the capital to make those investments. But these guys just like money was being shoveled at them. And they clearly just didn't have a particularly good, like, I'm just going to buy a lot of long dated bonds. Both like it turned out to be a bad idea, but it's also a sort of it's like an unbankerly idea. It's like what I would do if I suddenly had to do something with $100 billion.
Right. And this was weirdly Andy Kessler's point. Like this was part of Andy Kessler's point before he did the side swipe at DEI, which made no sense, which was that is the way that this bank was being regulated the right way, because they had all this cash and they're just throwing it into bonds, that they're not actually, they weren't equipped as that kind of an institution, and maybe they should have been regulated as a money market or as something else.
Here I think is the reality. If the San Francisco Fed had stepped in and done what they're supposed to do and said like, hey guys, like no, like this is not banking, you can't take this many deposits, then Silicon Valley Bank would have turned to their clients, who include a lot of prominent venture capitalists and startup people, and would have said to them, hey guys, too bad. We're not allowed to do business with you because these stick in the mud regulators who just don't get it are telling us we can't expand our business. And then those venture capitalists would have gotten on the phone to their members of Congress, right? They would have done, I mean, we just saw, right? When the venture capitalists might lose their deposits as required by law, they complained vocally and they got what they wanted. They got what they wanted, even though bailouts are really unpopular. If all they were asking for is let us put our money in the bank that we want literally nothing from the taxpayer other than permission to make uninsured bank deposits. Like the San Francisco Fed could have done the right thing, but the venture capitalists would have complained and they would have been overruled. You know what I mean? And they would have said, what is the problem? These are uninsured deposits, right? Why are you stopping us from making uninsured deposits? And what were they to say? Say like, oh no, really, like the deposits are insured, right? Like this is the sense in which it does, I think, it goes back to Congress declaring falsely that these institutions aren't systemically significant. Because even though we can all say in retrospect, well, the regulators shouldn't have let them grow like this, legally speaking, they were making uninsured loans to a non-systemically significant institution. So if, Azure Abbasi, executive director, executive vice president of supervision, who's like, this is an important person in the world, but not even close to being like one of the 100 most important people in American politics. If this one guy was out there being like, listen, if this bank fails, the FDIC is going to feel that it has to step in and guarantee the uninsured deposits, even though it's illegal for them to do that, because they're going to decide that the bank is systemically significant, even though Congress voted that it isn't. And that's why I'm not letting you do it. People would have been like, fuck you, man.
Well, what if the San Francisco Fed had looked at it and said, yo, you are taking in a ton of money here, you're putting it all in bonds, and you're at risk of failure, regardless of whether the FDIC is going to step in. The San Francisco Fed does not want banks to fail. So even if they were not making the argument Like one argument would be this, like that would be the logical argument of, hey, you're getting huge over here. You are no longer a small bank, but you are becoming a large bank and you dominate one industry. And and that does, I can see that seeming very unlikely for the San Francisco Fed to feel like it can assert itself in a way of saying Congress was wrong and everyone was wrong. And this is not, this is systemic risk. At the same time, the San Francisco Fed is supposed to make sure banks aren't failing. So regardless of whether or not you see this as a systemic problem, the bank was on track to fail. And the FDIC would prefer not to have to insure, to make payouts on insured accounts. So I don't think I see your point that, like, nonetheless, like, so your point would have to be like, what could they do as a regulator? And, the size of the institution, like the problem with it was that the way that they were investing their money is that they were shoveling it all into one place, which put them at huge risk of failure.
It did put them at huge risk of failure, but it didn't put the deposit insurance fund at risk. Right? Precisely because so much of these deposits were uninsured, there was plenty of money. Even with the bonds down 15%, they had plenty of assets to cover the insured deposits. So I just think the San Francisco Fed could have, and I should say should have, stopped them from doing this. But the only basis for doing that would have been to say Congress was wrong, the Federal Reserve Board was wrong, the FDIC board was wrong. Factually speaking, this bank is systemically significant and needs to be held to a stricter standard, which again, like, they should have done the right thing. I'm just telling you that, like, had they done the right thing, the VCs who spent the weekend begging for and receiving a bailout would have gone apeshit.
Look, this hypothetical scenario that you were laying out, I agree with. I just think that the San Francisco Fed, despite all of those political pressures, had another option. Like, you were very focused on your path here, which is definitely a legitimate path. And I am saying, when facing a problem, you can look for another route to a solution. And I think that the San Francisco Fed, had they been a little bit more creative and looked carefully at their options, may have come up with, hey, we're not going to convince Congress. We're not going to convince anybody that this is now a systemic problem. But you can pretty clearly see that that is the problem. And then you come up with a way to solve the problem, which is really what, again, happened. Like, that happens all the time in politics and in life, that the solution isn't necessarily to go with the most logical answer in the flow of what happened. You look at the problem and you come up with a way to solve it. And they could have taken some steps to say, hey, this is a systemic problem. We all kind of know it and we can't address that. But we can step in this other way and say you're at risk of failure individually. And again, maybe, obviously, people who want to invest in that bank and put their money there could have complained all they wanted, and maybe they would have won anyway. But to let the Fed off the hook, the San Francisco Fed, and say, there was nothing they could even do, like, even at a more moderate stance, that might have been easier to sort of slide through. To me, misses, like, the whole point. I just, like, reject the idea that the San Francisco Fed was in an impossible situation because of political pressures and otherwise. They had some options. And, like, I'm not disagreeing with you on your point about the broader problem here of pressures. I just think from a practical point of view, like, we all solve problems every day. I solve problems every day. And, sometimes I solve them rather than going head on saying the problem is X and this is what I'm going to do. I look at the problem and I solve it in a way that avoids big political problems. Like, even if you look at what's happening right now, for example, being able to solve, like, to prevent this, mass failure of the bank by using fees, is a kind of political way around dealing with the problem, right or wrong. It's a solution that politicians are taking. So I just think that, like, this being hung up on this is the logical way to think about it, and therefore the only way to approach a problem is just not. I'm like willing to, I just like will compromise my way through anything to get my way.
I am hung up on things I said in 2018 that nobody paid attention to or cared about. I would feel better if somebody said, hey, you know what? I was wrong about that thing in 2018. It turns out this bank was systemically significant.
Yeah, that would be great.
You know, like it would
Sure.
do so much for like my personal goodwill and sanity, because like that's what is going on here, is just that like there was this claim being made that never made sense, that a bank with tens of billions or hundreds of billions of deposits could just be obviously dispensed with in the way that like a tiny local rural bank could be. And it was like clearly untrue at every step of the way. And like a whole series of decisions, not just a congressional vote, but like subsequent rulemakings across multiple agencies were shaped that way. They were like, we are going to just pretend that we're going to let this bank fail if it fails. And then it failed, and everyone was like, oh no, it'd be bad to let the bank fail. And that sucks.
Yes, this is true. We have talked about this for an hour. I think you're totally right. But also over here in reality where bad decisions get made and you have to dig your way out of, fuck ups other people make. That is why you have regulators. Like that is why you have a system, because people have to do their jobs. And unfortunately, in this case, the systemic problem, what I'm talking about system here is what you're describing. And what I'm saying is not, oh, if this or that happened. I am saying as a person who looks at problems all the time, you got to deal with it. And you're not going to win. You're not going to have some, world where someone goes, wow, I really made a mistake. That is not what people do. So what you do is you have systems in place to try to do better and recognize that, yes, you're totally right, but it's not going to happen. So what is plan B? And plan B is you've got regulators in place who are going to try to at least enforce the regulations that are there, which I don't think is what happened in this case.
I think they should have let the bank fail. That's what I'm coming down to. I mean, I see why they didn't, but like I would have rolled the dice on this one.
Just because they were wrong and said this wasn't a systemic risk.
Well, maybe they weren't. I mean, it's the question. I would have run it forward.
Yes, they were wrong at the first place. But if you're now looking at the problem like, man, I got that wrong, and I have this set of tools to solve a problem that I now see, like, why would you sit there and go, you know what? Out of spite, out of me being smug,
it's not
and
spite.
You wanting to be right about my takes in 2018 or 2008 or 2018, they had a bunch of tools at their disposal to deploy if there's a genuine fear of a systemic problem. And it seems like there's a legitimate case that there was a systemic problem if they let this bank fail and that there were tools in place to use. And so to me, it is bad policy to say, these banks got away with it. And so therefore I'm going to let this problem happen. I mean, it's very sad. It is very hard to swallow.
I think it's a difficult decision, and I could argue it either way. But I mean, my case for putting it through resolution, right? Ultimately, it's a question of the rule of law. Like there were multiple steps of declarations that this institution was not systemically significant. And I think to turn around and be like, oh yeah, really it is. I mean, because the truth is we don't know, right? I mean, it's inherently uncertain what would have happened.
Let's let it fail. Because we believe it's not systemically a problem. We're going to let it fail.
I wouldn't even say that. I would say because by law of the United States, it has been declared that it is not systemically significant.
Okay, that's fine. Okay, but the conclusion is the same, that this is not a systemic risk. How do you then go back and say, you know what, these banks need to be regulated differently because they do pose a systemic risk if your position is they don't? Why would you double down?
You'd have to see what happens.
So then is it like, okay, now that there's been a lot of harm, we're allowed to say there is systemic risk? We can't just take really obvious inferences to make the case?
Well, no, no, no. I mean, it's because I'm not sure.
So if you're not sure that it is or isn't a systemic risk, if you like, why are you opposed to bailing out?
Because I think that I think that there's a strong argument that public officials should follow the law. Like the American people's elected representatives said that banks of this size are not systemic risks, should not be regulated as systemic risks.
But then there is this pot of money that's sitting there if it is uncovered that there is a systemic risk. And do I think it is good that these banks are called not systemic risks? But once you have determined you were wrong, what are you supposed to do? Not use a tool that is sitting there available?
Well, I just don't know. Because, look, I mean, listen. So, say Silicon Valley Bank, the depositors take their haircut and life goes on. But then there's a panic and some other large regional banks fail, and depositors of those banks also take haircuts. So, a bunch of money goes kind of up in flames. And then banks need to stabilize themselves by increasing the interest rates that they pay on deposits, right? So, people keep more of their money in the bank. Well, if this was 2008 or 2009, we would say, oh, that's terrible, right? That's going to slow down an already depressed economy. It's going to make our recovery from the Great Recession harder. We need to avoid that, at all costs. In the circumstances of 2023, though, you could say, well, look, that's fighting inflation. That's what we're trying to do. That's why the interest rates were rising in the first place. I think it's hard. I'm not enraged that they made the decision that they did make, but I also think it's like, I think it's tough to not acknowledge that, like, laws get made and that people deserve some kind of consistency and coherence and adherence to those rules. That's my take, much more than anything about diversity.
And I agree with that, but I think that your take is omitting a piece of the law, which is that regulators had a tool available to them to use, and they used it.
To be fair to them, it's probably going to be fine. Like, almost certainly. Like, I think this statement that, like, no taxpayer money is being used in this rescue is, like, pretty dubious. But, like, probably no money will be paid out. So it's all going to be completely fine. Like, the genius of these deposit guarantees is that if you tell people everyone's going to get their money back, then you don't actually have to give anybody any money because they don't, like, actually want the money back. So, like, it's probably going to be fine. And so I understand why they did the bailout.
I just think that it is true that from this situation, what has come out of it is that this bank, these VCs are saying, hey, this poses a systemic risk. We admit this and we want to be bailed out. And what probably won't happen, but should, is Congress says, okay, these banks admit this is a problem, that they pose a systemic risk and we need to change it. If we say they don't, and we're going to let them fail and we're going to march on believing that they don't pose a systemic risk rather than taking the opportunity to say, look, we've even got these VCs on record admitting that this is the case, I think we are in a better position to take bankers admitting what went wrong than sticking to what we had said before. Like, it puts us in a better position to move forward and regulate them. We both agree that has nothing to do with DEI.
Some of this is just like reflex on the right. Like, they're just like really upset about wokeness. So anything that happens, they're going to blame on that. But I also think that, like, there is a real, a refusal to reckon with the policy choices that, like, a lot of scrutiny was put on the 17 Democrats who voted for this bill. But, like, it was mostly a Republican Party initiative. All the Republicans in Congress voted for it. The Trump administration signed it enthusiastically. It was Trump appointees and the regulatory agencies who went and did this. And, they don't want to either say what I said and, like, they should have followed through on the logic of this law and made everybody lose their money. And they don't want to say, okay, we made a mistake, we need to change the rules. They're, like, casting around, and it's unfortunate. I mean, this is just, like, the earnest side of me, but, it's not obvious what the right answer to every policy question is. But if people aren't even trying to, like, engaged with the topic.
Yes, you get very emotionally wrapped up when people are not intellectually honest. I have seen that.
I mean, it's not just not honest though. It's just like not thinking about it. What do you actually want to happen here? And like, like of course a bank in San Francisco is going to go in for like a certain amount of like progressive cultural fads. Like that's just business, right? Like I was just in Kerrville, Texas, and the local banks there sponsor high school football teams. Now, if one of those banks fails, someone's going to look back and be like, why the fuck were they spending money on high school football? Right? But it's like they're spending money on high school football because it's Texas. This is what you do. It's marketing fundamentally. And like banks do marketing. That's part of sound business. In San Francisco, I don't think people are that into high school football.
I don't know what they're into or not. But yes, sure. It's I look, I think, yes, there is also something to be said about that. But the issue here is what happened, what went wrong, and what should we do going forward so we are not in this position. And unfortunately, what you were pointing out is there's a lot of obfuscation and not true conversation about what to do in terms of regulatory changes going forward. It's depressing.
All right. With that, I think we should.
Yeah, I think we could wrap it up.
Go back and do your own banking on your own time. This has been another episode of Bad Takes from Grid. We are produced as usual by District Productive, and we'll be back next week with more Bad Takes.